Turkish Airlines presents Business Africa.
Hello and welcome to this brand new episode of Business Africa. I am Ronald Kato. Coming up on this week's edition, Africa's growth prospects for 2025 look bright, but constraints such as debt continue to loom large. African borrowers are projected to pay nearly $100 billion in debt service this year. Plus boom in Africa, but slow down in China. What does Africa's surging cement market have to do with China? We give you the answer next. And the Suez Canal expands even as its revenues contract. Egypt says the expansion allows the canal to take more traffic and to better handle emergencies. Stay with us for the details. Thank you for joining us. Over 20 African countries will spend more on debt service than healthcare and education in 2025. And over half of total debt repayment will go to private creditors. And a lot of that is down to the cost of capital. African countries pay more to borrow compared to their richer counterparts.
Amidst global fragility, Africa remains a beacon of hope for economic growth. In 2025 and 2026, at least 44 African countries will annually outpace global growth forecasts of 3.2% and 3.3%. 6 of the world's top 10 fastest growing economies in 2025 will be African, according to IMF. Powered by oil and gas production, South Sudan, Libya and Senegal are among the top performers. The others are Sudan, Uganda and Niger. But there are constraints to be overcome, the key being debt. Today, 23 out of 40 African nations assessed by the World Bank are at high risk of debt distress or are already in distress. Africa paid out $163 billion in debt service in 2024, according to the African Development Bank. The figure is not expected to change much in 2025. Experts say Africa's debt crisis has been made worse by the rise of private creditors whose lending terms are opaque and are reluctant to offer debt relief. The bank says that the growing burden of debt repayments is a threat to achieving the continent's Sustainable Development Goals (SDGs), particularly in health, education and infrastructure.
My guest this week is David McNair. He's the Executive Director of the One Campaign. Thank you very much, sir, for your time. Impressive growth forecast for Africa by the IMF. But to what extent is high debt a risk factor?
The first thing to say is that over the last decade, Africa's debt has doubled. And debt is not a bad thing. If you look at Africa's growing population and the massive infrastructure needs, the continent actually needs more debt. But the problem is that the debt is too expensive. An analysis from my organisation, the One Campaign, shows that African countries could be paying about a 500% premium on private debt compared to what could be achieved with World Bank lending, for example. So what impact is this having? Well, on average, across Africa, debt is about 13% of government spending, which is greater than health spending and almost equal to education spending. And if you dig in deeper to countries like Kenya, Ghana, Ethiopia, they're spending far more on debt service than either health or education. So this is really providing a drag in terms of what governments could be investing in the future, and instead they're servicing this really expensive debt.
Talk about the growing role of private creditors who are sometimes criticized for offering opaque lending terms. How can their influence be reduced?
The other issue, and this gets to your point about private creditors, is that African countries are considered risky by these international investors, and therefore they charge more to lend money to account for that risk. But there's a lot of credibility analysis out there that points to the fact that these high ratings might not be warranted and could be due to a lack of data, some biases on the part of credit rating agencies, and some of the effects of regulations that came in after the financial crisis to protect the international banks. So one thing that the South African G20 presidency this year is proposing is to take on board the idea of a cost of capital commission. to bring together all the different stakeholders and say, okay, well, what are the things driving these high costs? It might be regulation, it might be credit ratings, it might be data. And how can we tackle all of those things to bring it down and also address the substantive drivers of high costs, which might be meaningful risk in terms of political risk or currency risk or whatever. And if we were to put together an international policy agenda that proposed reforms for all of these different sectors and institutions, it could reduce that cost.
What about the IMF and the World Bank? What role can they play in bringing down the cost of borrowing for African countries?
Well, I think it's true to say that the countries that have defaulted and are seeking restructuring of their debt have not been treated fairly. You know, the process has taken far, far too long. And I think we need the IMF to play a more proactive brokering role in ensuring that these debt restructuring processes, you know, move faster and that everyone is treated fairly. The other thing that the World Bank can do is that, you know, it has a really important role to play in, you know, taking money from capital markets. And because it is considered a very safe investment, it can pass on the low costs of lending to African countries. So we need the World Bank to lend more for infrastructure, but to do so more quickly. Part of the reason why African countries have gone to private bond markets is that they can get access to capital very quickly with limited restrictions. And the World Bank has lots of restrictions and moves way too slowly. So if it was to be more flexible, it could unlock more capital for countries at a much cheaper rate, and therefore they could get a lot more value for money.
David, nice to have you. Thank you very much for your time.
Thank you.
Now, Africa's cement market is growing fast. It is projected to expand from $35 billion in 2024 to $42 billion by 2030. That's an annual growth rate of 4.7%. One of the drivers of this growth is Chinese cement makers running away from a shrinking market back home. Huaxin, for example, has operations in 7 African countries, making it Africa's second largest cement maker after Dangote.
Driven by rapid urbanization, increasing infrastructure development projects, and rising construction activity, Africa's cement market is surging. The boom is also resetting the continent's cement production landscape with the entry of new players. Facing a stagnant property market which has affected prices and stringent environmental regulations back home, Chinese cement makers have been running to establish or acquire operations in Africa. Led by Huaxin, Chinese companies invested in 9 new cement projects in Africa in 2023 and 5 in 2024.
We've got this enormous infrastructure deficit in Africa. We've got this enormous demographic story that's continuing to play out. And therefore, I think the Chinese are looking at the medium term and saying to themselves, you know, this is potentially another China, not so monolithic, not so linear, but potentially a similar story. And I think that's what they're really looking at. And I should expect other BRICS types entities to look at the African continent more aggressively.
With 10 cement plants with a production capacity of about 18 million tonnes per year, Huaxin is now sub-Saharan Africa's second largest cement producer. Dangote remains the region's leading cement maker with an annual capacity of 52 million tonnes. Industry experts predict demand to stay strong in Nigeria, South Africa, Kenya and Ghana. Cement production is associated with pollution. Experts say African governments need to emphasise environmental sustainability and to enact strong policies to balance growth with local industry development.
The Suez Canal, the vital waterway that shortens the sea journey between Asia and Europe, has expanded by 10 kilometers. The expansion allows it to accept more traffic, an additional 6 to 8 vessels per day, according to the Suez Canal Authority. The canal's fortunes, though, have not expanded much since late 2023, as Houthi attacks disrupted shipping in the Red Sea.
The Suez Canal Authority said the latest expansion extends to the total length of the canal's two-way section to 82 kilometers from a previous 72 kilometers. The authority said that during a trial run, 2 ships transited through a new stretch of the canal's two-way section without incident. Revenue from the waterway, the gateway to the shortest route between Europe and Asia, has nevertheless tumbled since Yemen's Houthi militants began attacking ships in the Red Sea in November 2023 over the war in Gaza. Last September, President Abdel Fattah el-Sisi said earnings from the canal had fallen by 60% or more than $6 billion in 2024 due to the instability. The attacks have forced container vessels to go reroute their journeys away from the Red Sea, increasing shipping costs and times. The expansion increases the canal's capacity by an average of 6 to 8 additional ships per day, the authorities said. It also increases its ability to deal with emergencies. After the 2021 grounding of the container ship Ever Given, which blocked the canal for days, Egypt accelerated plans to widen the Suez.
And that wraps up this episode of Business Africa. I am Ronald Kato. The news is next on Africa News and at africanews.com. Bye for now, and I'll see you on the next episode of Business Africa.
Business Africa was presented by Turkish Airlines.